everyone this morning. We will be presenting to you, again, we're trying new things this year, so we'll be presenting your tax update in the form of 4 scenarios, which will encompass all of the changes from 2020, hopefully within those. If you have any questions as we're going along, please put your questions in the chat. We'll set aside some time at the end to deal with those. There will be a short pause between each scene for costume changes, so please bear with us. As Chris mentioned, don't forget to stay logged in for the entire session and take note of the code words. And speaking of which, the first one for this session is 2020, 2020. And now I have my first guest.
Good morning. Hello, Mr. Harris. My name is Dr. Kidwell. I'm a pediatrician with a practice here in Charlottesville. We've had a friend prepare our tax returns for a number of years, but I'm afraid our situation may have become a little more complicated after all this COVID business. I'd like to engage your firm, and I have several questions about our tax situation. I hope you can help me with them.
Well, it's very nice to meet you, Dr. Kidwell. I'll do everything I can to help.
Well, obviously, this has been a really challenging year for my practice. We had to shut down for a significant period of time, and we had several employees who tested positive for COVID, had to take time off.
Yeah, I've got several clients that are in the exact same situation.
Well, my first question is about those employees who took leave. Shouldn't I be able to get a tax credit to cover that?
As a matter of fact, you can. One of the first bills that was passed in response to the COVID crisis was the Family First Coronavirus Response Act. And included in that was some paid sick leave provisions for employees who had to miss work for exactly those circumstances. So what the act did was it provided 2 weeks of paid leave for employees under several scenarios, and the employer, when granting that leave and paying that client.
David, your mute is on. David, hit your mute button.
I did not hit my mute button. Did someone mute me?
Someone doesn't like David. Back to the 2 weeks of paid leave.
Okay, so you can have 2 weeks of paid leave that is basically funded by the government through a credit that you take on your Form 941. And the scenarios under which an employee would be able to take that is if they were quarantined due to testing positive for COVID or close contact with someone, et cetera. If they were experiencing COVID-19 symptoms and were waiting to get tested. If they were caring for someone who's quarantined, or if they're caring for a child whose school is closed due to COVID-19. Now, under that last scenario, they can actually get up to 12 weeks of pay at up to 2/3 pay. For the other scenarios, it's generally full pay that they can take with the sick leave.
Well, I don't think we took any kind of credit when we filed our quarterly taxes. Can we do that now?
As far as I can tell, you can do that on an amended return. I haven't seen anything that says you can't.
Okay, well, we'll give that a try. Maybe you can do that for us. Speaking of payroll taxes, we heard about something called the employee retention credit, but we didn't do anything about that. Should we have? Did we miss that boat?
Well, maybe. We'll talk about that. So let me tell you what the credit was. Basically, it provided a credit to employers that had suspended operations due to a government order or had significantly reduced receipts. And by significantly reduced, they mean that your revenues were down 50% or more from a quarter-over-quarter basis. So the second quarter of 2020 versus the second quarter of 2019. And you could take a credit for 50% of the wages that you paid to your employees under those scenarios. The maximum amount of the salary that you could take into account for that was $10,000, which at 50% means that the maximum credit ended up being $5,000. So that was a pretty nice benefit, again, claimed on your 941, et cetera. However, there are scenarios under which you couldn't get that. And the main one was if you had taken out a loan under the Paycheck Protection Program and expect to have that loan forgiven. Did you take a loan under the PPP?
Oh, yeah, we got a big loan. It was a couple $100,000. Does that make a difference?
Yeah, unfortunately it does. And I assume you expect to get that forgiven. You had expenses during the time period?
Yeah. Mm-hmm.
Okay. So since you had a PPP loan that was forgiven, you are not able to take advantage of the employee retention credit. So it actually works out pretty well that you didn't do that. However, there is one other provision that was part of that same act that you might be able to take advantage of even after you got a PPP loan, and that's the payroll tax deferral.
You mean we didn't have to pay our payroll tax? Wait, come to think of it, I don't think we did pay those. Our accountant said we used research and development credits to cover that. We did a lot of work developing a method to get kids to take their medicine this year. Turns out all it takes is a spoonful of sugar.
Who knew?
Well, does that sound right that we would have used that credit that way?
As a matter of fact, yes. The R&D credit, which you claim on Form 6765, generally has not been of a lot of use to some small businesses or practices like yours that are personal service corporations that tend to zero out their income. So if you don't generate a federal tax liability, then taking the R&D credit doesn't do you any good. So the IRS knew, or the Congress knew this, and decided they wanted to help that. So they passed a provision a few years ago that allows you to claim a portion of that credit against your payroll taxes. So this has been available since 2016. And what you had to do was on your Form 6765, when you filed it, you would have designated a certain amount of that credit, up to $250,000, as applicable to your payroll taxes. So you wouldn't claim the credit on the $3,800 where your rest of your business credits go, but it would go to your payroll taxes. Then when you got ready to file your Form 941, you also file Form 8974 that says, here's the amount of the credit that I took, and here's the amount that I'm applying to this period, and you attach that to your 941. And you can take that credit against the employer payroll taxes, both Social Security and Medicare. Not the employee part that you're withholding from your employees, but that credit can be used to reduce the employer payroll taxes.
Oh, interesting. Well, so it sounds like deferring the payroll taxes under the other thing we were talking about wouldn't have made any difference in our situation.
Actually, that's not true. You can actually defer the tax even if the R&D credit application means you never paid them. So, and you're not liable for them. So you can take the credit, eliminating all of your employer Social Security and Medicare, and then you can also elect to defer. And now this is a key point. You have to not make the deposits, right? You always have to deposit the money that you withhold from your employees' checks, but the employer portion, you don't want to deposit it. Once you deposit it, you can't defer it. But if you don't deposit it, you get to your 941, you take the credit that reduces it and eliminates it, then you take the deferral and you can actually get a refund for the amount. And remember, the payroll tax deferral only applies to Social Security tax, not the Medicare tax. So the employer portion of Social Security tax. And so for that amount, you can actually get a refund even though you never deposited it.
Wow, that sounds really complicated. I'm glad I'm going to have a good CPA like you. Listen, I did want to talk a little more about our PPP loan. We just started working on the paperwork for forgiveness, and I don't think we'll have to pay any of it back. So does that mean that the whole loan amount is going to be taxable income for our practice?
Well, that's complicated, very, very complicated. When Congress passed the PPP program, which I know P in the last P stands for program, but when they passed that, they explicitly said that the loan proceeds are not taxable even if they're forgiven. And so we thought, well, that's a great windfall for our clients. They'll be able to get this money completely tax-free. However, the IRS had other ideas. So the IRS, since they knew they couldn't claim it as taxable income, they said, well, let's instead say that any expenses that you pay with the proceeds from the loan are non-deductible because they were paid for with tax-exempt income. So the IRS has initially made that statement back in April, I believe, and then they doubled down on it later in the summer and said, no, this is clearly what we think it is. Now, Congress disagrees, and there are several bills in Congress that are designed to clarify that, no, not only are the proceeds not taxable, but also the expenses that you pay for with those proceeds are fully deductible. However, Those bills haven't passed yet. We don't anticipate that they will pass anytime before the end of the year. So you've really got an interesting situation. What the IRS wants you to do is to say, even if you're not sure at this point whether the loan will ultimately be forgiven, you're still supposed to not deduct the expenses. So you file your 2020 tax return, you don't deduct those expenses, and then if it turns out that you have to pay some of it back in the future, you would then go back and amend your return and claim a deduction for those credits, for those expenses. So that is a pretty nasty result. Again, there's no timetable for Congress to fix this. However, we certainly expect that they ultimately will. So that definitely makes things very, very complicated for this year and introduces some substantial uncertainty. We're going to interrupt this scenario now to give you your second code word, and that word is we, W-E, we.
Well, Mr. Harris, I wanted to ask you about something else. We also got a payment from the HHS to help out our practice. Is that taxable?
Generally, yes. There are some circumstances under which some practices, if they didn't meet certain criteria, would have to pay back some of the HHS payments that they received. So if you have to pay it back, obviously it's not taxable. Now, here's the rub. Once again, like the PPP, we have some uncertainty about what year that's happening in. If you don't find out until 2021 whether you have to repay any of your HHS, at what point do you make it taxable income? Do you say, well, I expect to not have to pay any of it back, therefore I'm going to go ahead and claim it as taxable income in 2020? Or do you say it's a loan until I find out that I don't have to pay it back, in which case I'm going to defer that and claim it as taxable ultimately when I get the verification that that I don't have to repay it.
Well, since sounds like we don't know when or even if that's going to be taxable income, how are we going to handle our year-end planning? How do we know how much bonus to pay out by the end of the year to zero our taxable income? That's what we usually do.
Yeah, and practices like yours are in a very, very complicated situation due to this. What we'd like to be able to do is we'd like to say, so one of the problems with a personal service corporation is that you have to zero out your income every year, otherwise you get hit with a nasty form of double taxation where the corporation has to pay tax. It used to be a lot nastier because you used to have to start off paying tax at the highest corporate rate, which then was 35%. Well, after the Tax Cuts and Jobs Act, the corporate rate got lowered to 21%, so that became a little less of a burden because it's a flat 21%. The first dollar is at 21% and it doesn't matter. So the penalty of being a PSC is a little bit less than it used to be, but it's still a penalty because then when you ultimately take the income out in the form of dividends, those are taxable to the shareholders as well. So you end up with a double taxation that you're trying to avoid. And the way that practices generally avoid that is they get to the end of the year, they figure out what they think their income is going to be, and they write checks as bonuses to their employees, enough to zero out all of their income. So that's a practice that we've been doing with medical groups and law firms that are C corporations for a number of years. And it's always worked really well. It's complicated, but we've been able to correctly forecast what people's taxable income was going to be. Well, this year we can't really. Because of the uncertainty about the taxability of the HHS and the PPP loans, we're just not sure what people's taxable income are going to be. And when you get to that end of the year and you have to zero out the income, I know if your practice is like most practices, you've got some long-lived assets on the books that you're taking depreciation over a long period of time, and you have to have debt on the books to offset that. So you end up going into a line of credit at the end of every year to pay out enough bonuses to zero out your income because of that mismatch between when the cash goes out the door and when the depreciation deduction is taken. So you have to hold this debt. Most people don't like to hold that debt. That comes with a cost. If the PPP loan is as tax-free an event as the IRS, as Congress seems to want it to be, then you've got a windfall to these practices that would allow them to pay down the debt, spend cash in that way rather than spending it on bonuses, making the practice healthier in the long run, and not ever incur that double taxation penalty. So that's a really good result. The problem is that since we don't know whether those expenses are going to be deductible, we're advising our clients this year to go ahead and assume that the expenses for the PPP loan will not be deductible, meaning that you're going to have to pay out bonuses, treating the PPP loan essentially as taxable income. So again, for this year, clients are faced, practices are faced with that same dilemma of having to set aside, go into debt to pay these bonuses out, and then wait until next year. So what happens next year, right? Next year, you find out that the loan was forgiven and that Congress has acted and they have decided that those expenses are fully deductible. Well, now what do? Well, you've got to go back and amend now. And now you've created a loss. And even if in the current year, we did know for certain that those expenses were going to be fully deductible and that the income was not going to be taxable, so we could afford to leave a lot of cash in the practice, you still have the complication that, doctors probably like to get paid. And they're probably counting on bonuses, and they see that PPP money as revenue to their practice, and they would like to see that paid out to them. And there's a downside to keeping a ton of cash in the practice, in that, number one, it's not doing anything for you. Number two, it makes it more expensive for new doctors who might want to buy into the practice. Because when you're accumulating this large amount of cash in the practice, then that's a higher burden for any new doctor to get over in order to buy in. So very, very complex situation this year. And so even if we knew, we would still be paying out some bonuses. We would still probably be generating some losses. What it would mean is that you would get to balance. Every practice is going to have to make that balance between how much do we pay down in debt, because ultimately we do believe this will be a windfall and this will be a cash infusion into the practice. It's just a question of how you balance how much cash you keep in the practice, how much compensation the physicians expect. And oh, by the way, if you're like a lot of practices, some of your physicians deferred pay entirely or took substantial pay cuts during the period when you were slowed down.
Right.
So again, you've got people whose personal financial situation means that they're going to need to get some of that money paid out at the end of the year as a bonus. So that's where we stand for the end of the year. It's difficult conversations that we're having with clients about how to balance these different factors, but ultimately we're advising them for this year, treat it as though the entire amount is taxable and the expenses are not deductible, the expenses aren't deductible, meaning that it is essentially taxable.
Well, thanks for that explanation. So speaking of taxable income, I had a few questions about that too. Were there any changes in the deductions for meals and entertainment? I feel like that keeps changing every year.
It does feel like that for sure. And not so much that the law changes, but that under the Tax Cuts and Jobs Act, the changes that were instituted there were very unclear. And the IRS has come out with some preliminary guidance, and then in October of this year, they came out with their final guidance. So back in the day, you used to be able to deduct up to 50% of expenses for meals and entertainment. And that was a pretty broad category. And, buying a client tickets to a ball game and going to the ball game with them is no problem. And you can also, deduct 50% of the, the hot dogs that you buy at the stand and the beer and whatever. And that's all fine, part of wining and dining the client. You could also deduct 100% of certain meals that were on the employer premises for employee morale, that sort of thing, Christmas party, whatever it is. There were lots of those expenses that you could deduct 100% if they were on company property for the convenience of the employer. So the Tax Cuts and Jobs Act essentially said, we're going to subject more of the meals to the 50% limit, and we're going to completely eliminate the deduction for entertainment. So entertainment goes entirely out the window, and now you're left with this really weird scenario. I take my client to the baseball game and I buy him a couple of hot dogs and a beer. I know I can't deduct the tickets to the baseball game because that's entertainment. But what about the hot dogs and beer? Is the fact that it was in an entertainment venue and that it was part of an entertainment event, does that mean it's non-deductible entirely, or does that mean I can get the 50% deduction? So the final guidance says that if the thing that you're paying for is considered entertainment, amusement, or recreation, then no deduction is allowed. But if the meals that are incurred at the entertainment venue in the enjoyment of the entertainment are separately stated, so you're not just paying one entrance fee and you get access to the ball game and a buffet, but if the meals are separately stated, then you can still deduct those at a 50%, even if they're at an entertainment venue. So I think that's a little bit of a change from what some people were interpreting the Tax Cuts and Jobs Act to have said. And the 50% limit does apply to employee fringe benefits. So even though things that, these things might be excludable for the employee under the fringe benefits, the de minimis fringe benefits, but they're going to be 50% deductible to the employer.
That's very helpful. So let me change the subject a little bit. In the last couple of years, our practice has invested a lot of money in new equipment. We took on some substantial debt to fund that equipment, and that means we incurred some losses in prior years. That bonus depreciation, that's what our accountant told us we were doing. And we have to pay a lot of interest on that debt. I remember in the Tax Reform Act, there were some limitations on the deduction for interest expenses. Is that going to apply to us?
Well, probably not, but let me give you a little bit of background on what that adjustment is. For large companies, there was and I don't have the number off the top of my head. I want to say that's something like over $5 million in gross receipts. I don't know how big your practice is. But under the Tax Cuts and Jobs Act, the deduction for business interest was limited to 30% of adjusted taxable income. I won't get into the description of adjusted taxable income. It's complicated. But generally speaking, if you had $70,000 of net income, but $30,000 of your expenses were interest, so that your adjusted gross income or adjusted net income before the deduction for expense was $100,000, you could deduct 30% of that, and you can have that full deduction, reduce your income to the $70,000. You don't have any add back. But if your net income was only $50,000 after the subtraction, so you had $80,000 before, then you were limited to $24,000 of interest deduction. So that's the general limitation that applied. It would almost certainly not have applied to your practice because of those size limitations. But boy, a medical practice that zeroes out its income every year is in an interesting situation with respect to that. Because if you did qualify that you did have to deal with that, when you've got zero taxable income, if you've deducted any interest expense, which, by the way, based on what we talked about before, because you had the debt that you take on every year in order to pay for that equipment that you purchased that's longer lived, or leasehold improvements and so forth, or because you took out a line of credit in order to pay out those bonuses at the end of the year, you're probably going to have some interest expense. So what happens if you get to zero and then, oh, by the way, 30% of zero is zero. So, or if you add back the interest, then you only get 30% of your interest as a deduction. Now you got taxable income, and now all your year-end planning is out the window. So it's really annoying if it did apply, but we haven't seen a situation where it did apply to a medical practice. For your information, if it ever did apply, for the CARES Act, what they changed for 2020 and then retroactively for 2019 was that instead of a 30% limit, it was a 50% limit. So it's a little bit better for businesses. There are still some businesses who are going to get limited that are heavily leveraged, but the 50% versus 30% is a nice break.
Well, so thanks for that explanation. Now, what about the losses that we had? Will we be able to use those losses to offset any taxable income we might have this year?
Yes. So, if you did have a loss in a prior year, in the past, the rules were that you could carry it back 2 years, or in some limited couple of years there, it was 5 years you could carry it back, and then you could carry it forward for 20 years. So the Tax Cuts and Jobs Act created two problems for you. Number one, it eliminated the loss carryback. So if you had a year in your practice where you missed on your year-end planning and you generated some taxable income and paid some tax, that you could, in the past, for the following year, you could generate a loss that you could carry back. Special loss rules for PSCs. And that was helpful. Under the Tax Cuts and Jobs Act, you can no longer carry back a loss at all. It carries forward indefinitely, but it does not carry back. The other one of the other limitations that you had that it doesn't apply anymore for other reasons, is it used to be that when you had a loss and you were carrying it forward to a year where you had income, you were limited on the AMT side to only being able to offset 90% of adjusted minimum taxable income. So I might have, $1 million of loss, and I might have $1 million of income in year two. And for regular tax purposes, it's a wash. They're completely wiped out. But for alternative minimum tax issues, I would have had a $900,000 loss. I'm paying tax on $100,000, and I've got a $100,000 AMT and OL carry forward. Well, that's a nasty result. Fortunately, we don't have to worry about that anymore, because for C corporations, the AMT is gone as part of the Tax Cuts and Jobs Act. So we don't have to worry about that part. However, one of the many ways in which the Tax Cuts and Jobs Act ended up transforming the regular tax into the AMT, which it did in a lot of ways, one of the ways was that the use of NOLs for regular tax purposes was limited, but not to 90% of taxable income, but 80%. So now, under that scenario, $1 million loss in year one, $1 million of income in year two, you can only deduct $800,000 of the loss, and you pay tax on $200,000, and then you carry it forward. So again, a nasty result for a PSC, or really any C corporation, is going to be subject to that double taxation. For the CARES Act, they realized that a lot of businesses were going to be generating losses in 2020, and they wanted to be able to get as much cash into the hands of these businesses as possible. So they did a couple of things. They said, we're going to allow you to carry back losses that you generated in 2018, 2019, or 2020 back 5 years. So this is what they did essentially in the aftermath of the Great Recession, is allowed a 5-year carryback, like 2008, 2009. They're doing the same thing here. 5-year carryback. If you had losses in 18 and 19, you were already carrying them back 2 years. Probably, no, because you would have been subject to the TCJA, so you would have not been carrying those back. You would have been carrying them forward. Now you can go back and amend those returns and carry those losses back the 5 years. So that's great. I ended up not doing as many of those amended returns as I expected. Maybe that's still coming down the road. You certainly have time, because returns that, 2018 returns that you filed sometime in 2019, you have until 2022 to go back and amend those returns and carry back those losses. So you got the 5-year carryback. That's a big help. The other big help is that for losses generated in 2018, 19, and 20, the 80% limit is eliminated. So you don't have to worry about, you can offset a loss that you generate in 2020 can offset all of your income in a future year. And in your situation, you've had some losses in the prior years that you've been carrying forward, not gotten to really use because you didn't want to be subject to that, situation. So you zero out your income anyway. Well, now you have the opportunity to leave some income in the practice, have that loss offset 100% of your taxable income, and not get hit with the double taxation. One other note is that losses that you generated before 2018 can still be used to offset 100% taxable income whenever they're used. So that's always been the case, but it's just a reminder that not only is the 80% limit removed for 18, 19, and 20, but it never applied to losses generated before 2018. That was a point of confusion that some people had, in the Tax Cuts and Jobs Act is, well, wait a minute, now starting in 2018 or 19, I can no longer offset 100% of my income in this year with prior losses. And that's not the case. It's about when the losses were generated.
Okay. Well, another thing I have on my mind, we've had people coming into the office to clean, extra cleaning, lots of that due to COVID. I don't know where they're finding all those Clorox wipes, but they're turning up with them. These folks are not employees, and we've always sent them a 1099 at the end of the year. But I heard there's something new about that this year.
Yeah, so they've got a new form. You have the 1099 miscellaneous. There is one other thing I wanted to mention, by the way, on your last question.
Oh, okay.
You mentioned that you had taken bonus depreciation in order to generate those losses.
Right.
It would have been a much better idea to take Section 179, and I'll tell you why. A couple of reasons. One, you're in Virginia. Virginia does not allow bonus depreciation, but does allow Section 179. So you put yourself in a situation where last year you probably noticed that even though you didn't pay any federal tax, you did pay some Virginia tax because all that bonus depreciation wasn't allowed. Now you're going to have different loss to carry forward for Virginia, et cetera, but that's not a good result. You want to take Section 179. The other reason is that if we hadn't had the CARES Act, which changed things, that loss would have been subject to those limits. But if you had taken Section 179, you never would have generated a net operating loss. You would have generated a Section 179 carryover. And the Section 179 carryover is usable 100% in the next year to offset your taxable income. So that would have been a much better result. And I'm glad you fired your previous accountant. So to get back to the new form, in the past, we've always used, I believe it's box 7 on the 1099 miscellaneous to report non-employee compensation. And it's always led to a bit of an interesting conundrum. We use 1099 miscellaneous for a lot of things. And non-employee comp is a little bit different than all those other things in terms of the expectation that it is going to get used or get reported on a Schedule C, right? We get this notification all the time when we put in 1099 miscellaneous information. Hey, you don't have that link to a Schedule C. Well, a lot of times it doesn't get linked, but non-employee comp usually does. Sometimes it doesn't. So what the IRS said is we want to really separate those two things. We've got the 1099 miscellaneous, but non-employee comp's a big deal, and we want to put that under its own form. So they did. So they removed the non-employee compensation box from the 1099 miscellaneous and put it into the 1099 NEC. So that's the new form this year, and it only reports non-employee compensation. One change is in the past when we filed our 1099s, you may have noticed that the forms had to be submitted to the recipients by January 31st so they could use them to file their tax returns. But they didn't have to go to the IRS until February 28th or 29th in a leap year, I suppose. So you had that month of gap. For the 1099 NEC, there is no gap. They have to be to the recipients by February 1st, and they have to be to the IRS by February 1st, just for the Form 1099 NEC. The 1099 miscellaneous, still due to recipients by before February 1st, but now that's not due to the IRS until March 31st for reasons that make no sense whatsoever to me.
I'll say that doesn't make any sense to me either. Well, listen, there's one other major factor for my practice. There's actually an LLC that owns the building that we operate out of. I own the LLC with a couple of the other doctors, and because this has been such a difficult year, the practice has paid very little rent to the LLC, and so I expect to have a pretty large loss on that entity. I remember hearing something about a new limit on deductions for business losses.
There was indeed. That was another fun part of the Tax Cuts and Jobs Act. We paid for that reduction in the corporate tax rate with a whole lot of nasty things, and one of them was this concept of excess business losses. So under the Tax Cuts and Jobs Act, a non-corporate taxpayer could only deduct $250,000 of business losses. So for a lot of our clients who, let's say you're an individual and you've got substantial investment income and you've got a winery or a horse farm that loses several $100,000 every year, we don't have any clients like that, of course. Then there was a limitation on the ability of that loss to offset their investment income. Under the CARES Act, they've removed that limitation for 2018 through 2020. So again, some opportunity to amend some returns, perhaps, that that had that limit applied in 2018 and 2019. In your particular situation, because you've got a rental LLC that is tied to the business, you may notice that on your tax return, when you get the K-1 from that LLC and you report it on your return, it's not reported as passive income. You think, well, rental income is passive income. Why wouldn't it be? Well, because it's linked to the practice. And so the practice that's an active trader business taints the rental activity and makes it not a passive activity, meaning that you can't use passive income from the rental activity to offset passive losses you might have from investments, let's say. So since the practice is a C corporation and you're not generating any business income as an individual from that, you're getting salary. If you have those losses and if those limits applied and you had those big losses on the rental activity, then you would be stuck to that limit of the $250,000 and couldn't use anything beyond that to offset your salary from your practice.
Wow.
But again, fortunately, it's not an issue.
So on the same topic of the LLC, my old accountant was telling me he was going to need some more information from me about the LLC because of the reporting, some new rules about reporting on the partnership. Do you know what he's talking about?
I do indeed, and this is something that is another change for this year, and it's kind of flown under the radar, so I think a lot of people might not be aware of it. The IRS is requiring, starting with the 2020 returns, that all partnerships report the partner's capital accounts on the tax basis. And a lot of clients, a lot of partnerships will report on either GAAP basis if they're filing GAAP financial statements, it's generally accepted accounting principles, or it'll file on something called the 704B book method, which means basically the operating agreement defines how the capital accounts are maintained, and that's how you report them on the K-1. Now that creates a complication for the partner because they have to then on their own maintain their tax basis in case their losses exceed their basis or they get distributions in excess of basis or when they sell their partnership interest or when their partnership interest is redeemed. Those are all things where we need to know what the tax basis of the partnership is. And in the past, partners have been responsible for maintaining their own tax basis, and to some extent they still are. But for things that happen within the practice, the contributions of capital, the income and loss in the current year, and the distributions from the capital account, all of those things have to be reported now on the tax basis. And there might be situations where the partner might have purchased their part of the practice from someone else. So they might have a difference in outside basis, and they may not have done a 754 election that stepped up and made those bases agree. But outside of that, it'll generally be tax basis. Well, that raises a big question if the partnership has always been reporting its income on the book basis. How do you determine your beginning tax basis? And generally speaking, the IRS has prescribed several different methods for doing it. And they've also, thank goodness, given us some penalty relief for any errors in case the beginning tax basis that you calculate isn't correct. But you're really going to have to go back to the beginning of the partnership, or at least at each partner's interest, and find out what their contributions were, what their taxable items of income and expense were, non-deductible expenses, of course, reduced basis, and then your distributions, and track that year by year to come up with what the capital account on the tax basis was at the end of the previous year. That's going to be your beginning balance. Then you apply the current year activity. So it's going to require some work for a lot of these partnerships to go back and recreate that tax basis that we should have been maintaining all along. Each partner should have been maintaining their own tax basis, but a lot of people weren't. So that's going to be some work.
Wow. Well, this has been very helpful. Thank you so much for your time, Mr. Harris. Now, you're not going to bill me for this time, are you?
And scene. Right now is a good time to do our next code word, which is will. W-I-L-L, will. Now we'll have a short break while we costume change, and we'll be right back. Hello, Mrs. Downs. I'm Mr. Young. My given name is David, but all my friends call me Knot. I guess because I tie a mean lure. I've been a professional bass fisherman my whole life, but I'm starting to think it's time to retire. Most people take up fishing when they retire. I don't know what I'm going to do. I'm thinking I might need somebody to help me figure out what to do with all my money.
Well, nice to meet you, Mr. Young. How can I help you today?
Well, to start off, I'm 70 years old. I turned 71 on Christmas Day. Could do worse than sharing a birthday with the baby Jesus, huh? I read something about having to take some money out of my IRA soon. Is that right?
Well, you heard that, and that's actually old news. It used to be that when you turned 70 and a half, you did have to start taking distributions out of your IRA, but we had a large tax act at the end of 2019 called the Secure Act, and it changed a lot of things. Changed a lot of things about IRAs, and one of them was that it did delay the date on which you begin taking your IRA distribution. So you don't have to take any money out of that until you turn 72. So you've got a couple more years before you need to start doing that. And in the meantime, another change under the Secure Act is that you can continue contributing to your IRA. It sounds like you're still pretty active in your business and earning some money. You can continue to add money to that IRA right up until you decide to stop working, even if it's past your required beginning date.
Hey, very cool. Well, I turn 72 next year, so I guess I have to start taking out money in 2022.
That's right.
I've got about $5 million saved up. Caught me a lot of fish. How much do I have to take out?
Well, so you're going to have to take out a percentage based on a table. There's something called the Uniform Lifetime Table, and that table's been around a long time. It calculates your life expectancy based on, demographic data, and just recently, actually, the Congress decided that people were living a little longer, so they've changed those tables a bit. And in 2022, just coinciding when you turn 72, those new tables are going to come into effect. And so your lifetime expectancy is about 2 years longer than it used to be. Good news for you. That $5 million, in today's dollars, if you were 72 and we were calculating it today, that $5 million, you'd have to take out $182,500 based on your life expectancy. Now, it used to be it was $195,000, so it's gone down a bit because they think you're going to live a little bit longer.
Woo, doggy, that's a lot of money. I suppose Uncle Sam's going to want his cut. Anything I can do to keep some of it away from him?
Well, that's a good question. It is going to make your tax burden go up, that's for sure. Really, there's only one way that you can reduce the tax burden on that or reduce the amount that you're paying tax, and that's something called the Qualified Charitable Distribution. Do you like to give money to charity?
Sure do.
Well, there's something called a QCD. It's not new. It's been around for a few years, but it is an effective way to reduce the amount of tax you have to pay on your RMD. So what you can do is you can take up to 100,000 of your RMD, which for you is about half of it. You can give that directly to charity. Now, it has to go straight from your IRA custodian to the charity, but if you do that, you don't have to pay tax on that money. It's as if you didn't receive it. The only one I want to point out is that Again, under the Secure Act, it does allow you, as I mentioned, for you to keep contributing money to your IRA while you're still working, even after you reach your required beginning date on your IRA withdrawals. But if you do that, and then you subsequently make a qualified charitable distribution from your IRA, you're gonna have to reduce the QCD by the amount that you contribute to the IRA. So that's a little bit self-defeating and something that a lot of people don't realize and needs to be kept in mind.
Well, I really hope that IRA is going to last me a long time. I want it to be there for my kids after we're gone.
Yeah, well, how many children do you have?
I got 3 boys, but one of them has some health problems, pretty serious ones. We expect we're going to have to support him the rest of his life.
Interesting. Well, I'm sorry to hear that. Well, the Secure Act that I mentioned before did really change the rules a lot regarding the inheritance of IRAs. So used to be that when your kids would inherit your IRA, they'd get to take those distributions out over their lifetime, and presumably that's a lot longer than your lifetime. So they could stretch those distributions out. We call it the stretch distributions. But the Secure Act decided that that was a little too generous to wealthy taxpayers. So for most people, they have dialed that distribution period back to 10 years. So that means that for certain beneficiaries, they're going to have to take out all of their inherited IRA over a 10-year period. Now, there are some people to whom that requirement doesn't apply, primarily spouse. So if you leave your IRA to your spouse because she survives you, then she can take it out over her lifetime. So that's really not a change. But if she's predeceases you, or you decide to leave that money just straight out to your kids, well, they're going to have to take it out over 10 years. So that's going to be a pretty significant amount of tax for those kids in a short period of time. Now, for your son that's disabled, that he's actually is considered what's called an eligible designated beneficiary, and he can take the IRA distributions over his lifetime. So Congress did recognize that there were some circumstances, like disabled children, also minor children, or somebody who's chronically ill, to be able to continue to have that stretch. But anybody else who's not one of those eligible designated beneficiaries will be subject to that 10% drawdown.
Man, that sure is a lot of money for those kids to get in a short time like that. Don't know if I trust them with all that money. They'd probably blow it all fancy learning and such. And it ain't like IRA is the only money I got. I always set some aside for a rainy day, and I guess I got pretty lucky with my investments. I probably got $20 million outside of the IRA. Any way I can spread it out so they get that money over a longer stretch?
Well, that's very interesting. Well, you don't have a lot of options, but there are 2 things you can do to try to control the amount of money that your children might get from that IRA. Because of course you've got some more flexibility with your other assets, your $20 million or so. You can spread that out for your kids by using trusts and vehicles like that. But with the IRA, you just have a couple of options. One is, well, we talked about this already. You do like to give to charity. And if at your death you think that you might want to leave some money to charity, well, using your IRA is by far the best way to do that. You can leave your IRA or maybe just part of it to a charity directly, and then let your kids, get the money for the rest of your assets in the way that you want them to, using a trust. There's one other thing you can do also using a trust, which is using something called an accumulation trust. You can have your IRA payable to an accumulation trust, and that trust does have to withdraw the IRA proceeds over the same 10 years. And I just want to clarify, when I say 10 years, there's not a specified pattern for taking the money out over those 10 years. It's that it has to be withdrawn within 10 years, and it can be spread out however the beneficiary chooses. So this accumulation trust would have the same 10-year requirement, but it would be able to accumulate that money and hold it in a trust and then distribute it, in whatever way you design using a trust agreement to your children over whatever period you feel would be best. Now, it's not necessarily the most tax efficient thing to do, but it does provide some control over how they receive those assets.
Interesting. Speaking of charity, I donated one of my boats to Fishing for Fun earlier this year. That's an awesome nonprofit that takes old people out fishing for free. The boat I gave them was the one I used to win my first tournament back when I was just an amateur. Bit of a collector's item, if I do say so myself. I hope I can get a nice fat tax deduction for that. What do I need to give you so I don't get audited?
Well, first things first, how much is your boat worth? Did you have it appraised when you gave it away?
They told me I might need that, so we did hire an appraiser. He said it was worth $50,000.
Wow, that's a good investment. And do you know how much you paid for it?
Shoot, I ain't got no idea. Bought it in Ireland 60 years ago.
Okay, well, let me tell you a little bit about what's involved in making a contribution like that to a charity. It's very, very generous of you, and you would be entitled to that $50,000 deduction on your tax return. We'll come back to whether or not you'll be able to take that deduction or not. But in order to get the deduction, you have to file what's called Form 8283. Not a new form. It's the form that you report non-cash charitable contributions to organizations. And for a contribution that size, an appraisal is required. So, I'm glad you went ahead and got that done. But you have to submit that information along with this form, which requires some other basic information, such as when did you acquire the property and how much did you pay for it, as well as who did you give it to, what was the value, etc. Now, this may seem like an innocuous form, but the IRS takes this pretty seriously, and I think that we all need to be paying a little bit more attention to it. There was a court case, tax court case that came out earlier this year that I think warrants pretty careful consideration, where the story was that a couple up in Potomac, Maryland, purchased a home for roughly about $300,000. Their plan was to have it demolished and then build their dream home on the lot. Well, they arranged to contribute this house to a nonprofit that employed disabled folks who deconstructed the house and sold materials for salvage, and they had a whole plan. They got an appraisal, $300,000, they made the contribution, that was all fine. They filled out the 8283, and they did not furnish the date that they acquired the house, which would not have been hard for them to do, or the price that they paid for it, which also would not have been hard since they had recently purchased it. They submitted that to the IRS, and the IRS disallowed the entire deduction for failure to furnish complete information. Now, there were some other problems with it, some things that weren't signed and some other issues, but so may not have been a really airtight contribution, but the basis for disallowing the contribution was just the failure to complete that pretty simple form in its entirety. So that's something that folks need to be pretty careful about going forward, I think. Now, so back to your question about whether you were going to get a tax deduction. So what you're giving away is personal property, and so it would be subject to some limits based on your adjusted gross income, which of course I don't know how much that is, but your $50,000 deduction would be limited to 30% of your adjusted gross income on current law. Now, if you had given cash, I just wanted to point out, and maybe you also gave some cash contributions, but cash contributions under the Tax Cut and Jobs Act a couple of years ago are limited to 60% of your adjusted gross income. But the new for 2020, the CARES Act increased that percentage to 100%. So in 2020, if you make a cash contribution, it can offset 100% of your adjusted gross income. The only limit being it must be cash, and it cannot be to something such as a donor advised fund. So is there anything else I can help you with, Mr. Young?
Well, my first wife passed away a few years back. Met this lovely girl and got remarried. My Vera's only 35 years old. She has her own business making wedding dresses. Calls it Vera Young Brides. Unfortunately, she got the Rona earlier this year. She's doing okay now, but when she got sick, she had to cancel plans to go on a big trip to Europe. Those jerks wouldn't refund her deposit. So she took some money out of her IRA to shore up her savings account. She had the IRA from some old job, and I'd forgotten all about it. I hope she doesn't have to pay no penalty.
Yeah, well, you said she's 45, so she's
5.
oh my goodness. Well, she's well under the age of 59 and a half, which is the age at which you can begin withdrawing from your IRA penalty free. So normally a 10% penalty would apply on distributions from your IRA at her age, but the CARES Act did provide some relief for that, and that 10% penalty can be waived. There's, of course, we need a new tax form or 10 every year. So we have a new tax form 8915-E on which you report withdrawals from your IRA under age 59 and a half up to $100,000. And you can get penalty relief if you either had the virus, which sounds like your wife did, or even if you didn't have the virus, if your pay was reduced, you were furloughed, you had to stay home to take care of children and couldn't work, you had a job offer that fell through. There's some pretty generous provisions, but it would appear that even just having had the virus is sufficient reason to withdraw from your IRA and not pay that 10% penalty. There's no requirement to submit a positive test result or anything like that. You have to sign the form and, promise that you're telling the truth, and you can get that 10% penalty relief. Now, of course, you're going to pay tax on that IRA withdrawal because you can't get out of that. But if it was a hardship, and I think it's probably not for you, given what you've described, but if it was a hardship to you, you could spread that tax over 3 years. You also can recontribute those funds to your IRA over 3 years. So there's quite a bit of generous flexibility with that for somebody who did withdraw from their IRA.
Anything else I should know about that concerned IRA?
Well, she is young, so I wouldn't want her to lose sight of the fact that, someday she will have a beneficiary of it, and most likely it won't be you, I'm sorry to say, Mr. Young, but she will want to be sure that she designates a beneficiary to her IRA. As we've talked about, it's important to have a beneficiary designated. The other thing that occurs to me is that since you've got a little bit of a window here before you turn 72 and have to start taking those great big amounts out of your IRA, maybe an opportunity for Vera to consider converting her IRA to a Roth IRA. That's a great tax savings vehicle. We really like that for long-term planning for our wealthier clients, and perhaps your tax rate will never be lower than it is today. We don't know what tax rates are going to do in the future, and we do know you're going to have a lot more income in a couple of years, so might be something to be worth talking about, whether she might consider converting that IRA to a Roth.
Well, now that we're talking about my demise, which is not my favorite topic, how much tax is my wife going to have to pay when I kick the bucket?
Well, assuming you leave your money to her, she's not going to have to pay anything. There's an unlimited deduction for estate tax for assets that go to your spouse. So she won't have to pay any tax if you leave your money to her. However, there is an estate tax threshold, and that threshold is $11,580,000 currently in 2020. It's very generous. It goes up to $11,700 per person in 2021. It's scheduled to continue to go up for for the next 4 years, at which point in 2026, January 1, 2026, that estate tax exemption is scheduled to go back down to its previous inflation-adjusted amount, which will be somewhere around $6 million, unless, of course, Congress changes the rules on us, which certainly could happen. So in any case, your wife would not pay, there would be no estate tax on your death, but upon her death under current law, you'd have about a $23 million exemption. She would be able to use your unused $11+ million exemption if you died here, fairly soon. And so she'd have a pretty generous $23 million exemption under current law. But again, tax law can change. There will be a sunset in 2026, absent other changes. And so, there'll be some tax to pay at 40%. But I think that we'd be a great resource for you to talk about how you might be able to save some of that estate tax in the future. But I think our time might be up here today, so we'll have to make an appointment another time to be able to discuss those matters.
Well, you sure have been awful nice, Missy. It's been such a pleasant conversation. There's no way you'd be billing me for this, right?
All right. Thanks, everybody. This is the end of our scene 2. We've got another code word for you, but I think I've lost track of which ones we're doing. Let's see. Hang on a second here. Our next code word is not, N-O-T, not, in honor of Mr. Not Young. We'll be back in just a moment. Hello, Mr. Harris.
Hello.
Mr. Harris, hello. My name is Karen Snoot. I'm hoping you'll be able to help us with our taxes. Our last accountant, he was a moron.
Well, I will certainly do my best.
Well, now my husband, he's a very successful executive, and I have 2 children, one in college, the other in high school. Before I decide to commit to your firm, I want to make sure you agree with me on a couple issues.
Okay.
So, first off, I got a check from the government for $3,400 back in April. It sure was nice. We didn't need it, of course, but did I mention my husband is very successful? Now, I spent most of that money at the spa as soon as it reopened. Anyway, I'm not going to have to pay tax on that money, am I?
Well, the payment that you got was called the economic impact payment. And it was actually treated as an advance of a credit. It's kind of like what they did back during the stimulus payments. If you remember the $600 stimulus payments that went out back in 2008, 2009, this is the same kind of deal. There's a credit that you will take on your tax return. So when you calculate your tax return, you'll calculate the amount of that credit, and then you'll offset the amount of that credit with the cash that you got for your economic impact payment. Now, if you hadn't gotten an advance, and then when you filed your tax return, it turned out you qualified for the credit, then you would have been able to get that credit as a refund on your tax return. But since you did, and let's say you got that $3,400 you said, let's say you get to file your tax return, and it turns out that one of your kids didn't qualify for it for some reason. Then you end up with, you would have had it calculated a lower amount of the credit, but you don't ever have to pay any of it back. So that $3,400 is yours to keep, and you do not have to pay any tax on it.
Well, that's great news. Now, my kids, they have some income from their investment accounts. If they have to file their own tax returns, I know you'll charge me extra. Can't I just report that on my return? How's that taxed?
Well, back in the old days, the kiddie tax, which is what this is called, was based on the parents' tax rates. So if you had a child who had more than, it changes from year to year, but right now it's $2,200 of unearned income, then that income used to get taxed at the parent's marginal tax rate. So that's the rate that the parents would pay on the next dollar of income. And that only applied at that point to children up to age 17, I believe. Well, the Tax Cuts and Jobs Act, another one of those nasty provisions, said that not only is the income now taxed at the trust's rates. So a trust has a much compressed tax structure and tops out at the corporate tax rate of 35%, or at least it used to. Now, I guess under so 35%. And so it was like the first dollar got taxed at those high rates, and that was the way that it was applied. That was kind of a bad result. What they found out, especially, was that for Gold Star families, which is the families who have lost someone serving in the military, they were getting some benefits under two different government programs, and so there were some anti-double dipping rules that made that problematic. So they would put the proceeds from one of the programs into a trust, and into a trust for the kids, and that income would flow through the kids. Well, the kids didn't work to earn that income, so it was treated as unearned income to them. So now you had income that was being taxed at these higher and very quickly going up tax trust rates. So under the CARES Act, they decided to, well, actually, no, not the CARES Act. Under the Further Consolidated Appropriations Act, the kiddie tax went back to the parents' marginal rates. So now, again, I know your husband's very successful, so your marginal tax rate probably isn't a lot lower than what the trust rates would have been. But what maintains under the Tax Cuts and Jobs Act that's different from before is that it applies to any child under the age of 18 or under the age of 23 if they're a full-time student. So both your children qualify for that, meaning that any income of theirs that's over $2,200 is going to get taxed at your rate. It's unearned income. If one of them has a job, that's earned income, and that's different, and they'd file their own return. But if all they have is unearned income, and it is up to $11,000 of unearned income, then you do have the option to just report that on your return. You would file Form 8814, and you would report each child's unearned income and apply the standard deduction, and then there's the first amount that gets taxed at normal rates, and then the amount above $2,200 would get taxed at your marginal rates, and then that way you don't have to file any returns for the children.
Okay, well, the other thing is we just bought a nice big house in a beautiful gated community, and because we didn't put 20% down, they are charging us private mortgage insurance. Can you believe it? Now, I know I used to be able to deduct that, and now I can't deduct it, and now can I do it again? What's the story with that?
Well, the deduction for private mortgage interest had been added at some time in the past, and then in 2017 it had gone away. At the end of 2017, they'd eliminated that deduction. Well, again, that same bill, that Further Consolidated Appropriations Act that was passed in December of last year, brought that deduction back. So the way it works is this: you have to have taken out the mortgage after December 31st, 2006. So since you just bought the house, I guess that works. However, and this is going to be a problem for you, the deduction phases out at 110% of AGI for a married couple filing a joint return. So if your income is above that, you don't get to take the private mortgage interest. Now, just to look more broadly at that question of buying the new house and taking the mortgage, you do have your mortgage interest, which is deductible. Now, I don't know how nice this house is and how nice the community is, but if the mortgage was over $750,000, you're going to be limited to the interest that's attributable to that amount. It used to be up to before 2018, it was $1 million that you could have in a mortgage debt and deduct the interest on. Now it's reduced to $750,000. So any interest on debt over that is not going to be deductible.
Well, what about charity? We usually give a little bit of money to charity. I don't want to give away too much, but I do want to make sure I get a good tax deduction. If we donated, say, $500, how much would we save?
Well, normally, because you have a new mortgage and you have presumably some mortgage interest, and even though your taxes are limited to a $10,000 deduction, you're most likely going to be itemizing on your return. So you'll probably get the full benefit of that charitable contribution. And, remember, you could give away a little more than $500 if your husband's as successful as he is. I'm not saying anything, but you do have the option to get a bigger tax benefit if you want to. You could give up to 50% of your adjusted gross income if you wanted to give that away. Now, this year, if, for instance, you didn't itemize for some reason, you do have the option to take a $300 above the line deduction. So that means it's an adjustment that we make in arriving at adjusted gross income, not an itemized deduction. So if you don't get above your standard deduction, which is $24,000 and some $100 for a married couple filing jointly, if all of your itemized deductions don't add up to more than that, then you just take your standard deduction and you don't really get any tax benefit for anything that you did. So someone in that case who made charitable contributions, the IRS said, well, we'll throw you a bone. We'll give you a little bit, or Congress, I suppose. And they said, we're going to have $300 that is allowed, even if you don't itemize, that you can take as an adjustment. And filing status doesn't matter. The language in the bill is it's $300 per filing unit. So presumably that means $300 for the husband, $300 for the wife as a filing unit, but it may be just limited to $300 on a joint return. I'll look into that for you. But in your particular instance, it really doesn't matter because it looks like you will be itemized. Now, one other strategy that we do talk to clients about, if they are very close to the standard deduction but not over it, is to take a couple of years worth of charitable contributions and combine them up into one so that you get over the standard deduction in 1 year, and then in the next year you just take the standard deduction and it doesn't hurt you. So that's a nice strategy for some people. But one thing we've noticed since these limitations came into play, the increased standard deduction, so something like 90% of people take the standard deduction now. And so we were worried that charities were going to get really hurt by that, because if people don't get the tax benefit, they're not going to give, right? But it hasn't turned out that way. It's turned out charities have done pretty well, even though people aren't getting the tax deduction. So I think a lot of people, the charitable intent really does dwarf the tax benefit.
Well, speaking of charity, my husband, he's kind of, I don't know what he's up to. He got involved with that crypto nonsense. I don't understand what the heck he's talking about. He goes on and on about his Bitcoin, and they go up and they go down, and I am sick of hearing about it. Could I give those away to charity?
Well, cryptocurrency is an interesting topic, and it's getting more interesting all the time. So cryptocurrency is, I'm not going to try to explain it because I don't understand it either. I'm not a computer expert, but it's a virtual currency. So a Bitcoin is worth so many dollars, and you can trade it back and forth on exchanges, and people speculate about all these new coins that come out, and it's all kind of crazy. But it's also kind of strange from a tax standpoint, because the IRS had to figure out how to treat that. And what they decided is, even though you can exchange a Bitcoin for cash, even though you can transfer Bitcoin to somebody else in order to pay for a good or service, just like you would transfer cash, the IRS does not consider it cash, doesn't consider it foreign currency. It considers it property, not a security, but property. So what that means is, when you sell or exchange or use some of that virtual currency to buy goods and services, and anytime you have one of those transactions, you recognize a gain or a loss depending on what you paid for that. So you have to keep track for all of these transactions about how much you paid for it and how much you sold it for. And you report that gain or loss on your return. One thing you can't do is, if I exchange my Bitcoins for Ethereum or whatever else, that's a taxable transaction. I can't do a like-kind exchange like I used to be able to do for some other types of property. And now it's just limited to real estate anyway, so it really doesn't matter. But you can never do a like-kind exchange for these virtual currencies. You're always going to recognize gain or loss anytime you got rid of one of them. But like any other appreciated property, it can be donated for fair market value. So you get the full deduction for the fair market value. But if there's a gain on the property, if you had sold it, you would have recognized a gain. But if you give it away, you never pay tax on that gain. So that's a really nice benefit. If he bought Bitcoin way back when it was down low, and now it's like $20-some thousand, and he gives it away, then you can get a big charitable contribution and you cannot pay any tax on the gain. So that's a nice deal. Now, one thing I want to warn you about is that starting earlier this year, I believe, the IRS started sending out letters because they realized that all this money was flowing back and forth in the forms of virtual currency, and they weren't getting a piece of it, and they weren't seeing how it was going. So what they did is, under their FinCEN rules that make it really hard to have a bank account in a foreign country and all these other things, they said they went to the exchanges where most people trade these things and said, you have to give us information on all of your customers and what transactions they've had. So now for the IRS, if you did transactions through, let's say, Coinbase, the IRS knows about all your transactions. And they started sending out letters saying, hey, we think you might have done some cryptocurrency stuff. Maybe you ought to report that. Now, there are 3 different types of letters they sent out. And one of them was just that one. Hey, we think you might have done something. One is, hey, we know you did something, you should report it. And one is, we think you have income that you didn't report and we're coming after you. That's the really bad one. You don't want to get that one. But last year and again this year, there's a disclosure on your tax form where you have to affirmatively say, just like you do about whether you have a bank account in a foreign country, you have to check a box that says you did or did not engage in any cryptocurrency transactions during the year. So hopefully last year you checked that box that you did and you reported any transactions there.
Well, my husband, he has been working, and he's been working from home a lot lately. I guess he's been crypto trading too, but can he take a deduction for his home office? Because he's just been underfoot all year long.
Well, so that's interesting. One of the things that's come up a lot during the time of coronavirus is a lot of people are working from home a lot more than they used to. And a lot of people are thinking, well, I've got a room in my house that I use as my home office, and I ought to be able to deduct that. The problem is if they're an employee, then the home office deduction doesn't apply. And even if you did get it, it would be a miscellaneous itemized deduction, and those don't exist anymore. So the general rule is no. Now, if he's got cryptocurrency trading, and let's say he's doing enough of that that it's a trader business for him, then that might make a difference. Or if, let's say, you had a business that you were running out of your house, and you had a room in your house that you used exclusively for that business, and that was your principal place of business for that trader business, then you could possibly be eligible for a deduction for your home office. So let's say you would have a Schedule C for your husband's cryptocurrency trading, or for your business if you had one, then you would file Form 8879, I think it is, and you could take a deduction for the business use of your home. Now, a couple of things. There was a couple of years ago, they put in a safe harbor provision that said you can, once you identify the number of square feet in your home that are used exclusively for business purpose, you can just take $5 a square foot and provide no other documentation, and that'll be allowed as a deduction. So that's there. But again, for employees, not eligible. However, I do want to mention a bill that's in the Senate right now that would restore unreimbursed business expenses and might allow for a possibility of deducting some home office expenses because of COVID. What it also does is it potentially allows a deduction for school-related expenses, because a whole lot of parents are managing their kids being home doing school right now. And also for internet expenses, because a lot of people had to pay a lot of money for internet. People in rural areas that have not had broadband internet have had to pay a lot of money and are paying a lot of money per month to get internet coverage. So there are some potential deductions there. So it's in the Senate. We don't know for sure whether that's going to get passed, but it is out there. But for right now, for him, your husband working for his business from home, there's no deduction.
Well, did I mention we weren't actually home for most of the year? When COVID hit, we bolted to our house in Myrtle Beach. We stayed there from April to October. Now, I don't want South Carolina getting any tax on my income. I already pay tax in Virginia.
That's true, you do. So that raises a really interesting question. So there's this concept in multi-state taxation called domicile, and that is, it establishes your residency. So if you're a resident of a state for the whole year, you have to report all of your income to that state, and you're taxable in that state on all of your income. Then if you have another state where you earn some income, then you pay tax in that non-resident state, generally speaking, and you take a credit against your Virginia tax for the tax you paid to that other state. And that works really well. If you are in one state and then you move to another state during the year, then you can have a part year return where the income that you earned while you're a resident of one state is taxed there, and what income you earned while you were taxed as a resident of another state is there. But You could also have some carryover where you might have, let's say, some time you lived in state B that you were earning income that's sourced to state A, like rental property on a property that's located there. So that gets really complicated, but there are nice mechanisms in place to make sure that you only pay tax on a given amount of income to one state. That's great. But that concept of domicile can come up and bite you, because your residency can be determined one of two ways: domiciliary resident or statutory resident. A domiciliary resident is where your principal residence is located, where you have your driver's license, where you're registered to vote, where your pets live, where your family members live. All of those things establish your domicile, the place that you'll come back to. And as long as that is in a given state, that state will say that you're a resident of that state. So since I presume you didn't change your driver's license or register your voter registration from Virginia to South Carolina, Virginia still considers you a resident for the whole year. South Carolina, because you were there from April till October, that's probably pretty close to, if not over, 183 days, or about 6 months. If you have more than 183 days in a given state in the course of a year, that state considers you a resident of the state for the entire year. So now you have a situation where you're a domiciliary resident of Virginia, but a statutory resident of South Carolina, maybe not for the whole year, but at least for the period of the year where you were living in South Carolina. You're not going to get a credit on your Virginia tax for the tax paid to South Carolina, because it's not a non-resident return that you're filing in South Carolina. It's a resident return. So in fact, under those scenarios, if you did go over 183 days in South Carolina and you didn't move your domicile to South Carolina for that time, you don't have a part year resident return. You don't have a non-year resident return. You have two resident returns, both paying tax on your income and no credit from the other state against that tax.
Well, I swear, if you try to make me pay tax on all our income in 2 different states, I will talk to your manager so fast your head will spin. And you better not be thinking about billing me for this time.
And scene. This is the time for our next code word, which is miss. M-I-S-S. Miss.
David, before we start scene 4, I think you may have missed one of the code words. Okay, how many, could somebody tell us how many code words we have?
That should have been the 5th one.
Are you sure?
Yeah,
So
you
that's
can
the
find
6.
it.
Oh, no. Question 6. Never mind. It's code 5.
Okay, all right.
All right, very
Thank you.
good.
Thanks for clarifying.
Hello, Ms. Downs. I got a few concerns that I wanted to talk to you about. I'm real worried about this change in government, and I'm really thinking there's going to be a lot of changes. And I just wanted to see what your thoughts were. I keep hearing about how the Senate's going to end the filibuster, and then they'll be able to do a whole bunch of crazy stuff, and they're going to increase the corporate tax rates up to 28% from 21%, and man, they're going to put a minimum tax on global book income of over $100 million, and that's going to cost companies a lot of money. And they're going to phase out that 199A, that qualified business deduction for high-income individuals. And I hear they're going to put some new restrictions on companies if they do offshoring. And man, they're going to do a tax on large financial institutions like banks. They're going to limit your losses that you can take on real estate. And this really burns me. They're going to increase our top individual tax rates back up to 39.6%. And not only that, this is the worst part. They're going to tax our capital gains and dividends at ordinary tax rates, 39.6%. Then, not only that, at the end of every year, they're going to make you mark to market. So you're going to have to pay tax on your unrealized gains at the end of each year at that ordinary rate. Then they're going to apply Social Security to wages over $400,000. So, now you have to stop at like 130 or 140. If you go over 400, they're going to bring Social Security back again. Then they're going to roll back the estate tax back to 2009 when it was only a 3.5 million exemption and 45% tax. And when you die, they're going to tax all those unrealized capital gains. So even though you're paying all the estate tax, you got to pay tax on the gains. And they're going to do some weird kind of foreign minimum tax. This is just crazy, all the bad stuff they're going to do. What do you think about all those things?
Man, we don't even know who's going to control the Senate next year. We have no idea what tax changes might be in store. And frankly, listening to you speculate about them is just a colossal waste of my time. I think I'm going to bill you for this session.
And see. So our last code word is you, Y-O-U. And now this will be a good time. We'll take 5 minutes and open it up for questions. And then we have a special guest. Anybody have any questions? There are no questions that she is aware of. All right, so I believe my special guest might be out there waiting. Oh, Julie.
We do have a hand raised. Let me see.
Okay.
Anna, you have a question?
I do. It's about the 1099 NEC. I was reading that attorney fees would go on the 1099 NEC, but attorney proceeds would go on the 1099 miscellaneous. So could you explain what's the difference between fees and proceeds?
So fees is where you pay the lawyer for the work they do on your behalf. And proceeds is when the attorney wins a case for you on a contingent basis and they get some part of the award. I think that's correct. So that's the difference in how those things are reported.
Thank you.
And we have another question. Does the payroll tax deferral apply to self-employed individuals? I didn't look at that specifically for this, but I believe that it does. It's been a while since I looked at that provision, and I can find that out for you. But I'm almost certain that it did, and that you could just adjust the amount on your Schedule SE for the deferral.
The last code word is coming. You haven't received the last code word.
I did. The last code word was you, Y-O-U.
Oh. You can ask me all the tax questions you want, but keeping track of the code words is not my strong suit.
It's difficult, and because we don't have slides, they don't show up on the thing. I don't know if we're allowed to do a recap, but it all makes one sentence that I think a lot of us can agree on very strongly.
Recap, Dave. Go ahead.
All right.
Put on the phone.
The sentence that's made up of all of our code words is 2020, we will not miss you. And now I'm going to bring in my special guest for a special performance. This is something that's been missing from our tax updates for a couple of years. We have a song for you.
Hi, Julie.
Julie and I will be performing this as a duet. You're a mean one, 2020. This year has been a drag. I've been getting all my dinners handed to me in a bag, 2020. The thought of another greasy Big Mac combo makes me want to gag.
You're a monster, 2020. Your virus isn't cool. My husband works from home and now my kids don't go to school, 2020. If I don't get some me time, I'm gonna drown them in the pool.
You're a vile one, 2020. The summer was a bore. Instead of going on vacation, we've been doing lots of chores, 2020. We've been doing so much cleaning that we're eating off the floor.
You're a foul one, 2020. I hate to wear a mask. Just to see a friendly face and room to breathe is all I ask, 2020. All you had to do was not be terrible. Was that such a hard task?
You're a rotter, 2020. I'm sick and tired of Zoom. Tired of seeing all my colleagues sitting in their living rooms, 2020. Every time I see my face staring back at me on my monitor, I plot my webcam's doom.
Coming, you nauseate me, 2020. Can't wait to see you go. You're as welcome as a fungus on my grody pinky toe, 2020. When I think about what fresh horrors you still might have in store for us, I don't really want to know.
The end.
Let me applaud for all of the 90 people out there, David and Julie. That was awesome. Thank you.
And with that, we